Module 4. Interpreting high and low P/E ratios. A high P/E ratio generally implies certain implications related to growth expectations and market sentiment. Here are the key implications of a high P/E ratio. Growth expectations. A high P/E ratio suggests that investors have high growth expectations for the company. They are willing to pay a premium for each dollar of the company's earnings because they anticipate strong future growth. A high P/E ratio indicates optimism about the company's prospects for expanding revenue, increasing profitability, or gaining market share. Investors believe that the company has the potential for above-average growth compared to its peers or the broader market. Market sentiment. A high P/E ratio can reflect positive market sentiment and investor confidence. It indicates that investors are optimistic about the company's ability to deliver future earnings growth and are willing to pay a higher price for its stock. A high P/E ratio may suggest that the company is perceived as a market leader, innovator, or disruptor within its industry. It can also indicate favorable industry dynamics or a positive macroeconomic environment. Premium valuation. A high P/E ratio indicates that the company is trading at a premium compared to its current earnings. Investors are willing to pay more for each unit of earnings generated by the company, which implies that the stock is relatively expensive. This premium valuation can be justified if the company demonstrates strong growth potential, competitive advantages, unique business models, or other factors that differentiate it from its peers. Higher risk. While a high P/E ratio can be an indication of growth prospects, it also suggests higher risk. The market has high expectations for the company, and any failure to meet those expectations can result in a sharp correction in the stock price. A high P/E ratio leaves little room for disappointment, and any negative news or weaker than expected earnings can lead to a re-evaluation of the company's valuation, potentially causing a decline in the stock price. Vulnerability to market corrections. Stocks with high P/E ratios are often more vulnerable to market corrections or changes in investor sentiment. In times of market downturns or shifts in market sentiment, stocks with high P/E ratios tend to experience sharper declines as investors may reevaluate their growth expectations and become more risk-averse. It's important to remember that a high P/E ratio alone does not provide a complete picture of a company's valuation. It should be considered in conjunction with other financial metrics, qualitative factors, and a thorough analysis of the company's fundamentals, growth prospects, industry dynamics, and competitive position. Several factors can contribute to a high P/E ratio for a company. While a high P/E ratio may indicate positive market sentiment and growth expectations, it also carries certain risks. Here are factors that can contribute to a high P/E ratio and the associated risks. Strong earnings growth. A company with a high P/E ratio often experiences strong earnings growth. If the company consistently delivers robust earnings growth, investors may be willing to pay a premium for its stock. However, if the company fails to meet the high growth expectations, it can result in a significant correction in the stock price. Industry or sector growth potential. Companies operating in industries or sectors with high growth potential may command higher P/E ratios. Investors anticipate that these companies will benefit from favorable industry trends, market expansion, or disruptive innovations. However, if the industry or sector faces challenges or experiences slower growth than expected, the high P/E ratio stocks within that industry may be vulnerable to a revaluation. Unique competitive advantages. Companies with unique competitive advantages, such as strong brand recognition, intellectual property, or a dominant market position, may have higher P/E ratios. Investors believe these advantages will enable the company to generate sustainable earnings growth and outperform competitors. However, if the company's competitive position weakens or if new competitors emerge, it can put the premium valuation at risk. Positive market sentiment. Positive market sentiment can contribute to higher P/E ratios. During periods of bullish market conditions, investors may be willing to pay higher prices for stocks, leading to elevated P/E ratios across the market. However, if market sentiment shifts to bearish or risk-off sentiment, stocks with high P/E ratios can experience sharp declines as investors become more risk-averse. Low interest rates. In environments with low interest rates, investors often seek higher returns in equities, which can drive up stock prices and P/E ratios. When bond yields are low, stocks become relatively more attractive, leading to increased demand and potentially higher valuations. However, if interest rates rise, it can impact the attractiveness of high P/E ratio stocks, potentially leading to a revaluation, associated risks, disappointment in earnings. High P/E ratio stocks are susceptible to significant price declines if the company fails to meet or exceed earnings expectations. Any disappointment in earnings growth can result in a downward revaluation of the stock, potentially leading to a decline in the P/E ratio. Vulnerability to market corrections. Stocks with high P/E ratios tend to be more vulnerable to market corrections or shifts in investor sentiment. During market downturns or periods of increased risk aversion, these stocks may experience sharper declines as investors reassess growth expectations and become more cautious. Increased volatility. High P/E ratio stocks can exhibit higher volatility compared to stocks with lower P/E ratios. Price movements can be amplified as investors react to changes in growth prospects, market conditions, or any news impacting the company. Increased volatility can lead to higher risk for investors, potential for overvaluation. A high P/E ratio implies that the stock is trading at a premium relative to its earnings. If the market has excessively priced in future growth or if growth expectations are not met, there is a risk of overvaluation. This can result in a reversion to a lower P/E ratio, potentially leading to a decline in the stock price. Investors should carefully evaluate the factors contributing to a high P/E ratio and assess the associated risks. Thorough analysis of the company's fundamentals, growth prospects, competitive position, and industry dynamics is crucial to understanding the sustainability of a high P/E ratio. Interpreting low P/E ratios can provide insights into potential value opportunities in the market. A low P/E ratio suggests that the stock is trading at a lower price relative to its earnings, which can indicate undervaluation. Here's how to interpret low P/E ratios and identify potential value opportunities. Undervaluation. A low P/E ratio indicates that the stock is priced relatively lower compared to its earnings. This can be an indication that the market is undervaluing the company, potentially presenting a value opportunity for investors. It suggests that the stock may be trading at a discount compared to its intrinsic value or the value of its earnings potential. Contrarian investing. Low P/E ratios often attract contrarian investors who seek out undervalued stocks that the market may have overlooked. Contrarian investors believe that the market has underestimated the company's true value, and they take advantage of the potential price appreciation when the market eventually recognizes the stock's worth. Potential for future growth. A low P/E ratio can indicate that the market has lower growth expectations for the company compared to its peers or the broader market. However, it's important to assess whether the low P/E ratio is justified based on the company's fundamentals and growth prospects. If the company has strong growth potential that the market has not fully priced in, it could present an opportunity for investors to capitalize on potential future growth. Income opportunities. Low P/E ratio stocks may offer attractive dividend yields. When a stock's P/E ratio is low, it suggests that investors can acquire the stock at a lower price relative to its earnings, potentially resulting in a higher dividend yield. This can be appealing to income-focused investors seeking stocks with relatively higher dividend payments. Risks and fundamental analysis. While a low P/E ratio can indicate potential value, it's important to conduct thorough fundamental analysis to understand the reasons behind the low valuation. Evaluate the company's financial health, growth prospects, competitive position, industry dynamics, and any risks or challenges it may face. A low P/E ratio could be justified if the company is experiencing financial difficulties, has uncertain future prospects, or operates in a declining industry. Remember that a low P/E ratio should not be the sole factor in making investment decisions. It should be considered alongside other financial metrics, qualitative analysis, and a comprehensive assessment of the company's overall value proposition. It's crucial to have a well-rounded understanding of the company's fundamentals and market dynamics to identify true value opportunities.